In this chapter, we're going to look at a very important application in business, and that is, how do you figure out what asset to purchase? That is, what is an asset's value to the company? What is the benefits that an asset will bring to your company if you purchase that asset? And this process is something called capital budgeting. It's the methods that we use to justify acquisition. Now, there are always assumptions that we have to make, right? Long-term assets generate increased cash flow by increasing or improving efficiency, effectiveness, right? They could just be purchasing assets, right? And in the end, these are assets or new assets that are going to increase the return of the value of the company. But there's also, we have to have an understanding about the rates of returns on investments and the current inflation rate in the economy. So the capital budgeting process is all about implementing the strategic plan, right? What is it that we want to do in the future, and what assets do we need to buy to complete that process? How well we implement that, and if we can minimize the expenses of doing that, then we will then be able to create value for the owners of the company. So what we're worried about are changes in government regulation, any future changes in strategy, what happens in research and development, can we devise new products, etc. But all of these internal and external factors will have an influence on capital budgeting. So frequently somebody will say, well, if I don't know what's going to happen in the future, then why should I plan on anything? Well, if you're planning on things and if you have a strategy, you can react to things as they happen rather than just going through the paces and then not understanding why things are happening and how they affect the business. So the actual steps in this process is we need to formulate a proposal. We need to have an idea to work with. We then need to gather some data and evaluate that data. We have to do some analysis on this proposal. We then make a decision, decide to do the project or don't do the project. And then, assuming we do the project, we need to follow up. We need to monitor things. Since we're basing this on our estimates of the future, one of the things we know that is probably true is the things that we estimated or predicted to happen aren't going to happen. So we have to then follow up. And if there are corrective things that need to be made, we need to make corrections along the way to fine-tune the product. Again, the project. In the end, the objective is to buy an asset and to use an asset to generate the greatest amount of efficient and effective use for the company. Efficiency and effectiveness should translate itself into increasing wealth of the owners. There are a couple of ways of thinking about cash and how we make these decisions. The first thing we want to talk about is the difference between different types of projects. We could talk about an independent project or a mutually exclusive project. Independent projects are projects that have cash flows that are unrelated to each other. The acceptance of one of these projects has nothing to do with any other project that we're considering. Mutually exclusive projects, though, are projects that compete with each other. When you would accept one of these projects, it eliminates all the other projects in that set. And if you kind of think about almost any asset that you buy, you're probably not going to look at just one. You're going to look at 4 or 5 pizza ovens, for instance. you only need one pizza oven, but you're going to look at 4 or 5 because you want to find the best. And that's the idea of mutually exclusive, is you're going to analyze these projects that are all essentially the same project, and then only one is going to be accepted. So what a company ends up doing is, through the initial analysis of all its projects, it takes many projects and eliminates them down to one only. And then we have a series of 2, 3, 4, 5 independent projects. And once we get to that independent level, then we can start to decide what asset group we're going to buy that ultimately will help increase the value of the company for its owners. We also have a situation where, in theory, we assume that companies have unlimited amounts of money. And at the corporate level, especially if you think about the S&P 500, this really is pretty close to being true, right? Most S&P 500 level companies can generate huge amounts of money because of their size. For small companies, though, this is not true. For small companies, capital constraints is probably what keeps most companies from growing, and in the end could actually keep most small companies from even surviving, right? So capital rationing assumes that we're going to put a fixed number on how much money we can actually gather. So this can either be mandated by management, or it could actually just be part of reality that you can only get X number of dollars at a time. And certainly this will have an impact on which projects you can actually do and which ones you can't do. So we're going to look at 3 basic methods of analyzing data. There are more. In fact, when you look at the spreadsheet and the answers that come along with that worksheet, you'll see that there are others, but these are the ones that are the basic projects, if you will, or techniques to analyze projects that are most useful for small business and entrepreneurs. So if we look at a couple of projects, projects A and B, and you see how the project is listed out, each one has some predicted cash flows, etc. So as you can see, we have these 2 projects. They have slightly different prices, different cash flows. And I will tell you that the easiest part of capital budgeting is the stuff that we're going to talk about. It's the actual analysis of the data. The prediction of these cash flows is the hardest part. We need to predict the cash flows. That means we have to predict the net income. We have to predict financing needs. All of those things need to be projected moving forward, and that's a very difficult thing to do. That's where the uncertainty actually lies. It's in the prediction of cash flows. So the first category that we want to talk about is something called the payback method. And of course, there's a video here that you can watch that discusses this payback method. But essentially, it is the amount of time it takes for you to receive your money once you spend the money. Right? So it's the payback, it's the recovery period for getting your cash back. So the length of time, the acceptable period, time frame, this is determined by management. And quite frankly, this is the downfall, if you will, or one of the primary weaknesses of this payback period, is that there's no scientific method for us to determine how long this period should be. So it is subjective in nature. But if the payback period is less than the maximum acceptable, you would accept it. And if it's greater than the maximum acceptable, you would reject it. Now, what you will notice here is there's no equals to. It's either less than or greater than. I typically like to think that I would assume that the acceptance would include the equal sign. Now, your textbook and most textbooks don't talk about the equal part. But in reality, if you say you want your money back in 3 years and your money comes back in 3 years, you would accept the project. So this should be less than or equal to the maximum amount. So again, it's a very basic technique. It's very simple to use. And we'll show an example. We'll talk about this when we actually see the worksheet. The net present value is a method that takes into account the time value of money. So it applies the discounting procedures that we've talked about in other videos. The idea here, or the discount rate that we use, right, the rate for understanding what return we want to receive, is based on our cost of capital. It's based on what's referred to as the weighted average cost of capital of the company. And that incorporates some riskiness. In previous chapters, we talked about interest rates, and we know that the interest that you pay on a loan is different than the interest that I pay on the loan, based on my financial standing, on your financial standing, on the economy, on the riskiness of what we're going to do with the money itself. So all of those things have importance when you think about the cost of financing a project. So the net present value utilizes this cost to determine the value of the asset that we're buying. And it's a simple formula, and it basically says that if you get more, if the benefit is greater than the cost of buying, then you purchase the asset. So there are two interest rates, or two ways we need to think about this cost function, this cost of financing. It's the interest rate that's charged by the suppliers or the lender of the money. So if you go to a bank and you want to borrow money for your business and they tell you it's going to cost 8%, that is the cost of financing for you. In addition, right, it's the interest rate that the borrower could receive by investing in some other enterprise, right? So there's an opportunity cost that also could be associated with this. So there's a couple of ways of thinking about the cost of financing. And in the end, there are three pieces or three component parts to interest rates. There's what's referred to as the real rate. This is the rate of return that you would receive if we didn't have any inflation and there was no risk. It's just a basic interest rate. The inflation premium is added to the real rate to determine what we would refer to as a risk-free rate. So if you invested in something and could receive the risk-free rate, right, you would have no chance of loss, no chance of losing purchasing power on your money. However, if there is some risk associated with this process, we have to add something called the risk premium, right? The risk premium is different based on the company, based on the person, based on the financial status of the person. So again, how this interest rate is created, how it is generated, is a fairly complicated process. But let's see if we can put this into some basic terms. The weighted average cost of capital of a company is obtained by finding the cost of debt. What does it cost to borrow money? We then also need to find out what is the cost of equity. What is the opportunity cost to the owner for giving us their money to invest? We need to figure out then what proportion the company finances in. So again, a simple example, you buy a piece of equipment for $100,000, you're going to put $30,000 down and finance the rest. So the $30,000 is investor money, $70,000 is debt. So your opportunity cost for the $30,000 is 4%, and the cost of the loan is 8.75%. So we now know what does it cost to use my own money, and what does it cost to borrow the money? So in this case, we know what? It's $100,000. The equity portion, the ownership money, is 30% is going to be the owner's equity. The 70% then is the debt proportion. If you multiply the proportions by the costs, in this case, it's going to cost the company roughly 7.33% to finance this project. How we use that then is we insert that 7.33% is this R. It's the required rate of return. We have to get our cost of financing. So this is the present value of future cash flows. That essentially is the benefit that the project brings to the company. Subtract from that the investment. This is what it costs to do the project. So net present value is essentially a cost-benefit analysis. The value of the project minus cash flow. If the value, right, if net present value is positive, then using this weighted average cost of capital, we should do this project. Why? Because the benefit to the company exceeds the cost to the company. And in the end, that net amount, who receives that? Right? The owners, their equity is going to be influenced by this net amount. In the terms of a corporation, net present value measures the change in shareholder wealth or stockholder wealth. In addition, in a partnership, it would indicate the change in the ownership equity. There are a couple of advantages. Number one is it looks at time value, and it uses an interest rate that's based on cost of capital that takes into account the riskiness of the asset and the riskiness of the person that's gathering the money. So again, this process, this technique incorporates some very basic things we've talked about throughout this entire course, right? That we need to predict future cash flows. We need to understand the influences on those cash flows from within our company. We also need to have an understanding of our risk and our cost of doing business. So the final technique to talk about is something called the internal rate of return. Again, the internal rate of return, quite simply, is just the actual rate of return you receive from buying this asset. And of course, it uses time value of money to calculate this answer. If the internal rate of return is greater than the cost of capital, you accept the project. Said another way, if this project earns a higher rate of return than the cost of financing the project, then the project is good. And again, it's just a basic cost-benefit analysis where the benefit is the rate of return of the project and the cost is the cost of financing the project. And again, there are some challenges with the internal rate of return, but in general, it's a fairly familiar kind of a process or a product, if you will, of analyzing this data. So if we look at these two projects, Project A, we have a discount rate of 10%. Remember, the discount rate, that is the weighted average cost of capital. It reflects the cost of financing this project. Project A has a payback period of 3 years, and we want 3 years. So in this case, if we were only looking at Project A is acceptable. Project B has a payback period of 2.4 years. Again, we wanted 3 years. So if these are mutually exclusive projects, that is, we have to pick the best of the two, in this case, we would say that Project A is better than Project B. If you look at the net present value of Project A is $11,000, and B is $10,000. Both of these are positive. So if we could do both of these projects, we would like to do both of them. Both of these projects will increase the value of the company, the worth of the company. However, if we can only do one, we want to do project A because its number is higher. It will increase the value more than B will. The internal rate of return for project A is 19%, which is greater than the 10, so project A is a good project. Project B is at 21%, and again, that's better than 10, so project B is a good project. So if we wanted to do both of these projects, we would do them both. However, if we were only looking at the internal rate of return, the internal rate of return is 21% for B, it's 19% for A, so project B appears to be the better of the two projects. And these two projects are very similar. This does reflect one of the challenges with the internal rate of return is that it doesn't agree with net present value, right? Our goal, your goal as an entrepreneur, your goal as a financial manager for a company is to find ways to increase the value of the company. If you're increasing the value of the company, your current owners are going to be happy and satisfied because their wealth is tied to the value of the company. New investors or people looking at your company are going to be encouraged. They're going to be optimistic about the company. So they're going to want to buy your company. In all, the fact that everybody is happy, everybody wants to buy into this company will increase the demand curve, which will increase the price or the value of the stock. So in conclusion, the thing we have to finish, as we mentioned in an earlier slide here, is we still have to follow up, right? As time passes, this is a 5-year cash flow. Every year we have to come back and review what we did. What were the actual cash flows compared to what we predicted? Where were there issues? Where were there challenges? Can we fine-tune our prediction process? But in addition, do we have to make changes in what we plan to do with this asset, or do we just let it go? Business is all about in the education world, and we always talk about closing the loop, right? You have to think about doing something. You have to go out and do something. And while you're doing it, you have to review the things you're doing. If things are not working well, you need to review and act. You can't wait till things destroy or just explode and then try to figure out what's going to happen. You have to constantly maintain and monitor your business as time moves on. So that's the end of the chapter on capital budgeting.